Hey everybody, Jake Gino here, and today we're going to give some insight into what it looked like when we started investing in apartments over 10 years ago. We hope that this will give you some clarity and fill in any gaps that you may have. Now, remember, your business doesn't start out as a well-oiled machine. We know that better than anybody. It was very clunky when we got into the business, and we tried to do everything ourselves. So there's a ton of mistakes that we made, and we just want to offer insights so that you don't have to make the same mistakes, and we can hopefully speed up the process and ultimately shorten your learning curve. Now, it's crucial to learn how to buy right in various market cycles. When we started out over 10 years ago, banks were stingy. They didn't want to give money. Capital was on the sidelines, okay? Much different than today where there's just a ton of cash out there. Banks are giving loans much easier. You need to know how to buy right in all the market cycles. What do they say? The best time to buy was always 5 years ago. I'm sure that's very true. But we're buying in this market cycle. We bought 10 years ago. And the G Daddy is going to give some insight into what things looked like from his perspective when we started out over 10 years ago.
Jake, I wish when we had started out 10 years ago, I knew what the three pillars of real estate were. It's market cycle, number one, debt, and exit strategy. Go to jakeandgino.com. We discuss the three pillars of real estate, and it's also in our books, Creative Cash and Real Estate Raw. And this is one of the biggest mistakes that I made early on before I met Jake. I didn't have the three pillars of real estate, meaning I didn't know what they were. We put them together. The market cycle is crucial. Before I met Jake, I was buying deals, but I wasn't taking into consideration this market cycle. I was buying in the wrong part of the cycle. I wasn't getting the proper debt, and I didn't have any kind of exit strategy. So when Jake and I partnered up, it was such a different time. And the GDP was at 1%. And deals were out there, but the banks weren't lending. So we actually did creative financing on our first deal. And then we started doing more deals. We started to figure out, well, the market cycle really plays into it. And how many of you out there have said the market has been at a high for the last 3 years?
Guilty.
2018, market's high. 2019, market's overperforming.
I'm not buying in this market.
2020, 2021. You just have to know what type of assets you need to buy in this part of the market cycle. And when Jake had mentioned the buy right criteria, I challenge you all out there. Write this down because this is very important for you to start buying these assets correctly, because you should be able to buy assets in every part of the cycle, but you need to know the exit strategy in that part of the cycle. In this part of the cycle, Jake will talk about he wants long-term fixed rate financing, because when the market does cycle down, and eventually it will, you want to take that interest rate risk off, and you don't want to be stuck with interest rates rising. And all of a sudden you've got an asset that's performing, but all of a sudden your rates are rising and you don't have that debt locked in. So it's really, really important. Buy right criteria. What are you buying? What we're buying in this part of the market cycle, assets that are a little bit smaller. There's less competition in those 20 to 100 units. The second part, we're buying assets that are a little bit newer. We're afraid that, there's a lot of CapEx on these older assets built in the 60s and 70s with cast iron plumbing, roofs, HVACs, hot water heaters. There's a lot of stuff that you need to replace in these older assets. And in this part of the cycle, we're really high. You have C properties that are trading pretty close in cap rates to what B properties are trading for. So we'll pay a little bit more of a premium for a newer asset. We like brick buildings. In some parts of markets, they don't have brick. So just know when you're dealing in your market, what you're looking for, right? What kind of buildings they have. We like the newer assets, anything 85 and newer. I mean, some assets, you can go back into the 80s. We bought 80 assets. And what we've done is we've repositioned them and we've rebuilt them out to become brand new, right? We're also looking for properties that have a decent median income. Depending on your market, look at what the median income of the area is. It's really, really important, because if you're going to be charging a certain amount of rent, you need to be getting at least 3 times what the median income of the market is. We like 2 bedrooms. We love 3s, but in our market, there are not a lot of 3-bedroom units. We like townhome style apartments. Jake will even get into, we don't really love breezeways. We don't like decks. Hey, if they've got garages, great. Get really granular on what you're looking for in your assets, because that's what we've done. And what that allows you to do is it allows you to focus, and it allows you to talk like a pro. So when you're going to a broker, you're going to go to the broker and go, I want this 80s build, washer dryer hookups, possibly, between 20 to 100 units. I want median income $50,000 and greater. I want 2 bedrooms, townhomes preferably. And the broker will start listening to you and say, wow, you guys are really dialed in. If I find something, you're the one to call.
So that's a great overview of what we're looking at in today's market, what we're doing. But go back to when we first started, though, because we have multiple accountants now. We have a team of attorneys. We have construction in-house. We have multiple team members helping in the day-to-day. It didn't start like that,
No.
though. And so someone out there that's maybe they're about to close on their first 15 or 20 unit, and it's just them, or maybe it's them and their partner, them and their wife. What did our team look like, and what were we lacking? And go through a little bit of the transition of
That's a great
scaling
question.
up, because that's going to give folks the clarity that's really needed to
Yes.
say it's okay. Jake and Gino have been there before, and that's what it looked like. And I can go, on a similar path.
Jake,
you don't go from 0 to 100 like that.
What I would say to you is it's really important. What was I doing before I met you? I joined the mentorship program, and
I thought you were cleaning dishes.
I was washing, but I was doing that. But on the side, I was with a mentor. I had two different mentorship programs because I had done deals in mobile home parks and I had done really bad. I had done a mixed use strip mall, done bad. And I finally said, I want to learn this multifamily because I can't do single family homes part-time while I'm working in my restaurant. I was in the restaurant business when I first started out. So the very first thing that I did before I even bought any kind of multifamily assets with Jake was I went and I got educated. I spent about a year diving in with my mentors, learning about how to invest in multifamily.
We spent 2 years before we found anything.
Yes, that's the first thing that everyone should be doing, because if you're going to be investing any significant amount of capital or time, you should invest in yourself. Your income can only grow to the extent that you do. Let me say that again, because that's really, really important. Your income can only grow to the extent that you do. When we bought our first deal, we got really lucky because for so many reasons. But if we didn't continue to educate ourselves, we would not have found that third deal. I was in it with another mentor on our third deal. So when you're first starting out, what you really need to do is spend time, take a deep dive, find a mentor out there, find a mentorship program or an education program out there, invest in yourself, hold yourself accountable, found a community that you can really start networking with and learning. The second thing you need to do is it's all hands on deck. Jake and I did everything together. It's not, oh, I'm going to find what I love to do. You really need to learn the entire business. By your second or third deal, you're going to start saying to yourself, well, Jake, you don't like the bookkeeping. I'm going to do the bookkeeping. You're in the market. You take care of the property management. I'll take care of the asset management. I'll take care of the underwriting. You take care of the brokers. But when you're buying your first or second deal, it's all hands on deck. And the crazy part about it is when you're starting out, it's important to note that you're going to be the I'm a person. I'm going to do this and I'm going to do that. Eventually, when you buy your third or fourth deal, I'm going to get burned out. So understand with the end in mind. It's almost like the exit strategy of buying a deal. You're going to grow into an entrepreneur and you're going to start hiring those people out. Don't worry about that on your first and second deal. Your first and second deal need to be really stable deals where there's not a lot of risk on these deals. They're really good deals that you can manage. And they're really good deals that fit your criteria. It may take a little bit longer to find those first and second deals. But I promise you, after we found our first deal, after 18 months of rejection, after rejection, 3 months later, we found our second deal. And 6 months after that, we found our third deal. That's called a snowball effect, because all of a sudden, things start clicking. Things start making sense. Oh, wow, now I got a deal to underwrite. Now the broker knows that I'm a closer. He's going to send me another deal. That's what ends up happening. But in the beginning, it's all hands on deck. And after about 75 to 100 units, you start figuring out that it's a multifamily entrepreneurial venture. You need to become an entrepreneur and need to start building out all those various team members.
You make me laugh. I almost blew this entire episode up because you said we got lucky. What? That 25 unit, we got lucky. We bought a dilapidated 25 unit with a ton of deferred maintenance, and the septic fields failed within the first 2 months. But that's a growth mindset. That is so important to have in this business, because did we get lucky, or did we take a problem off of someone's hands and actually turn it into something very nice? I think it's the latter, but we did get lucky though. We got into the game. That was the most important thing that happened to us. We stayed persistent and we finally got a deal done. And then we figured it out from there. Hands-on management, full transparency. We did not know what we were doing when we started, period. Gino got educated, so he was fortunate that he could get me the documents that we needed to show the banks, the different statements that we needed to do. So the education was there, but the day-to-day management, we didn't know. It was literally trial and error. And then we started to systematize and document, and it grew from there. And it's becoming, I don't want to say we're a perfectly well-oiled machine yet, but we're on our way, and it's constant improvement every single day. Him and I, bookkeeping, property management, we did it all in the beginning, financing, buying, all of it. But then we grew, and then we got team members, and it started little by little. It was progression. There's going to be things that you don't know. And that's, to Gino's point, where the mentorship can fill in those gaps. But the key is to start. I'm going to summarize it. The best thing we ever did, this guy and I, we didn't quit. We stayed in the game until we got one done. Okay. We learned, we grew, constant improvement. The market's different. We've adapted with the market. Gino talked about buying small. We went from 25 units to 300 units, and now we're back down buying mid-sized units because we adapt with the market cycle. We're owner operators. We hold for the long term. So we're simply looking for value and great homes for our residents to live in. Okay. We said it before. Everyone's saying, should I get into multifamily now? The best deal was 5 years ago. The best deal was last year. If you stay in it long enough, okay, you stay in the game for a minimum of 10 years, you're holding these things. You're going to go through some ups and downs, but over time, inflation is going to take place. If you're in a growth market, that's the key where people are moving to. The asset should be worth more long-term due to inflation and due to population growth, due to good economic drivers, if that's the market that you're talking about. So that's why we have a 100-year long-term mindset. Okay. And we said it before, constant improvement. You need to always be working on your systems. We've spent hundreds of thousands of dollars on coaching for systems, multifamily improvement, speaking, whatever the case may be. We've invested into ourselves, and we're always working to sharpen our sword, make our team better, and find competitive advantages. It's just what we do. And Gino has the story. He has the journey in a little something called the Honeybee, and he's going to give it away to you today for free PDF copy if you email him, Gino@jakeandgino.com. Other side, Honeybee right there with the stripes. And really, that's a little parable about our journey and what it took to ultimately get to multiple streams of purpose and giving back. Gang, it doesn't happen overnight, but ultimately you stay in the game, you work on the constant improvement, people, systems, and culture. You focus on those three things, you can get there and make it happen.
Jake, I'm just going to wrap this up by saying fortune favors the bold. And we were bold back about 10 years ago. We knew that we wanted to leave our W-2 jobs. We knew that we needed to invest in ourselves. I looked at it as an expense. Right now, every time I invest in myself, we are the best assets that we could possibly be. You're listening to this right now. You are your best asset. Shouldn't you be investing in yourself every single day? Go to jakeandgino.com/apply and learn about our mentorship program. Learn what it takes and the community that we've built. Multifamily is a team sport. Community continues to grow. Over 35,000 units that our community's taken down. Over $2 billion in assets under management for the community. And it's taking years to do that. But once the snowball starts, it just continues to get bigger and bigger.
Okay. Thanks so much, Gino.
Thanks, Jake.